Hey guys, Clinton Sistrunk, Colorado Mortgage Team. Today I want to talk to you about DTI, or debt to income ratio. This is one of the most common acronyms that we use in our business, and it's just a ratio of debts to your income. So there's actually two different debt to income ratios that we calculate. One is a front end, one's called a back end. One is just your debts divided by your income, and one is your debts plus your housing ratio divided by your income. The most important one is the one that encompasses all of your debt payments divided by your income. So let's break that down so you know what that looks like. First, let's talk about the debt side. When trying to calculate your debt to income ratio, you're going to go out and you're going to get all your minimum monthly payments on all your debts. So think things like auto loans, installment loans, student loans, credit cards, things that don't show up on the credit report, you're not going to include into this debt list. So you won't put in cell phones and utilities and car insurance and that kind of thing. But you might have, let's say you pay child support, or you have a garnishment you're making a payment on, or a 401k loan. Those kind of payments would be included in your debt to income ratio. You're going to add all those debts together, and then you're going to add the new prospective mortgage payment to it as well to get a full figure of your debt profile. And let's just say that's $2,000 a month. Now you're going to go and you're going to get your monthly income amount. And let's say it's 4,000 for ease of numbers. You would take your 2,000 in debt payments, your 4,000 in income, divide the two, and you would have a 50% debt to income ratio in that scenario. Now, the income piece becomes very tricky because most people don't know how to calculate loanable income in the eyes of an underwriter. They don't just use your pay stubs and what you make hourly. Unfortunately, that's not how it works. Most people have forms of variable income. Variable income could be things like bonuses, overtime, shift differential, commissions. When you fall into something like that, you have to have a 2-year history of it, and they add up all that income over 2 years and divide by 24 months. We get these figures from a full verification of employment. There's a lot of other nuances to calculating loanable income from an underwriter. So we highly suggest that you go through the pre-approval process so you know exactly what that income number is, and you're not working with wrong information when you're out there looking at the marketplace and what you'll be able to purchase. Many of these online calculators and even the pre-qualification process allow you to input the income number. And there is a place where you find lots of errors and get wrong information. So the best course of action is always to go through the pre-approval process, let your lender go to work for you and get you the exact information that you need. Another piece to consider when you're looking at debt to income ratio is what is the right ratio for me? And that is a different answer for everybody. Now, loan products will have different cutoffs. Some will be at 43, some at 45, some at 47, some at 50, some at 55, and VA will even let you get into the 60s. But just because you can go that high with your debt to income ratio doesn't mean you should. And this is where a custom mortgage analysis that we perform for all of our pre-approvals gives you the information on what your expectation is for monthly payment, cash out of pocket, that kind of thing. So you can figure out if you want to go that high or if you want to keep it lower and what that would translate to in purchasing power. This way, you can maintain your budget, stay on track, and not get over your head financially. At the end of the day, the rules from underwriting on your max DTI are not where you should be for debt to income ratio. That is a very specific question for each individual family, and only by gathering the information that you need to empower yourself will you be able to get the right answer of what's the purchase price and payment that we should be going after. That is our goal, to empower you with that so that you have that information readily available when you're out shopping for a home. All right, that covers debt to income ratio today. If you'd like to get the process started and figure out where yours might land, put your information in below and we'll be happy to go to work for you.